The year 2021 is meant to be the year of recovery. We've got our vaccine, we've got a date of an unlocking now, the world's gonna open up again, we're all gonna travel the world again and get back to normal. But however, the market starting on end of February to the starting of March is on a huge sell-off. It doesn't really make sense. And what makes it worse is the media and the news are not explaining why the market sell-off is happening in this month. Is it a correction? Is it a crash? What is it? Today I want to give you an explanation to make it simple in layman terms for non-finance economist people like you and me. Hi, welcome back to Family Investment. My name is Alex Ko, and here I'm helping you family investors make up your mind what you need to do. But before that, there's two key charts that you need to understand the basic fundamentals. Then further on, I explain the real reason why the markets sell off. And eventually in the last segment, I want to share with you what I will be doing to give you an idea what needs to be done in this investor's world. So I'm gonna kick off by sharing with you two fundamental charts that you need to know as an investor. First one is called the yield curve, and followed by the inflation data. These are two key charts that you need to know. The first one, the yield curve. So the yield curve is what the Federal Reserve used, and for the yield curve, it's basically a plot on the x-axis of all the bond interest rates from 0 to 5, 10, 15, 20, 30 years of the UK, US bonds interest rates. Let me start with the most common one. It is called the rising yield curve. As you can see, the rising yield curve is basically the shortest bond interest rates, the shorter term bond interest rate are the lowest, and the longest bond interest rates are at the highest. It is rising. The higher the bond interest rate rises, Federal Reserve needs to control by rising interest rates. So as you can see on the pink line, if it ever goes even higher, interest rates needs to go up to have a counterbalance so that the bond rate doesn't go up way too high. The second one is the declining yield curve. The longest bond interest rates or the 20-30 years are going really low. It's getting really unattractive to invest, and hence it goes down. And to ease it that way, interest rates will have to decline. And this has happened recently in 2020 during the COVID-19, where interest rates have to decline all the way down so that the bond interest rate maturity doesn't have to go to extremely low possibilities. And then the other two ones is the hump yield curve, where the medium term bond interest rates are higher, the shorter term and also the longest term. And lastly, you get the flat yield curve. The flat yield curve is where the maturity of bonds, regardless of the shortest term interval or the longest term interval, they're all the same. Where your interest rates are pretty flat, that's where you get your bonds rates are at a very equal flat level. And finally, I want you to burn it at the back of your memory, the rising yield curve, because this will help me explain why the markets is on a sell-off. And now on the second one, which is the inflation data that you need to know. The four different common types, and these four will help you understand the macroeconomic situation in your individual countries. So the first one is the very common one, is the inflation. So in a growing country where the country is growing, GDP is growing, people are working, people are spending, you get a rising inflation rate. Your basic salary, your basic wages are still increasing to creep up demand. So these are common in the likes of US and China, Korea. That's where you get a rising inflation rate. But then you got the second one, which is called the disinflation, where inflation is on the decline. This has happened, again, most commonly during the COVID to every single country, where you can see the inflation decreasing because people are losing their jobs, people are not getting money in, people are spending less, are becoming oversupplied. Services and goods are oversupplied, people are less likely to spend. The third one, as you can see on the chart, where it goes to zero, similar to disinflation, but deflation, where it goes to negative, where the employment rate is so high. It's so high that everybody's losing jobs, companies and factories are closing down. And finally, what's key important is called the reflation. So reflation is where you get a disinflation or disflation, and the government gives its support. Okay, that's where the government prints money and start buying bonds, push things and help people spend money, help people spend services and money, and encourage the economy to go in a cycle again. So reflation is an artificial way that the government helps to push and get the economy running, basically get people to spend money. So now let me show you the current inflation, annual inflation chart. So this is a very good chart that I found on Google here. So the current inflation chart shows, as you can see, that the inflation rate has been going down. But look at in 2020, where we've got a rising inflation rate up to January of 2.49. But then because of COVID-19 came, everything started closing, travel started closing, business started closing, the whole world basically went into a standstill for many, many months. And that's when the inflation data started falling into a disinflation mode. And the government quickly stepped in with monetary policy, monetary easing to print money, to give it up to individuals to spend, to get things going, to get businesses going again, even though there's nothing being sold out there. So that actually helped us to beat the deflation mode, where we actually go in the negative, and help push it up easily, as you can see, the month of May, June, July. And that's where we see stock market going up. Things are going up in terms of the tax cycle, stocks are going up. So things are going really well. So why did the market sell off? Market sell off is because the reason why is because the 10-year interest bond rate has gone up from 1 to 1.5%. It's quite a rapid rate. So if the 10-year starts going up, the shorter term interval bonds will start going up as well. And if it goes up, you're going to see a common rising yield curve. And if anybody sees a common rising yield curve, it suggests that the inflation rate is coming back. We're going to have a normal inflation data. Normal inflation data, a common rising yield curve, it just suggests that the economy is back on its feet. And when this happens, what's going to happen next? Interest rates going to rise. How? When the interest rate rise, meaning the Feds will have to stop printing money, they have to stop buying bonds, they have to stop support, they have to stop giving away cheap money. And when that happens, they have to cut back on their spending on bonds, and then companies cannot borrow cheap money to start rejuvenating the business. And then this way, when interest rates goes up, it is not good for the stock market. When interest rate goes up, stock market tends to come down. So this is why there was a huge sell-off at the back end of February, and potentially on the early March and onwards, and people are getting very, very cautious about the situation. And also a couple of thoughts that I just want to quickly summarize to you is, do not panic sell. If you hold good quality companies, just hold them, average down, hold them for long term, because as an investor like you, investor, not a trader, you're here for the long term. And also buy good stocks at a discount just now. Some of these stocks are at discount. Some of these stocks are cheaper before their earnings came out. And thirdly, if you don't have cash, stay on the sidelines, okay? You don't necessarily have to do anything. 4 is stay invested for the long-term market, okay? We're here as investors, we're not traders. You're here for the long term, you want to grow for the next 5, 10, 15, 20 years. So also on the 5th note, I want to share my personal experience is to take notes and journal. Emotions are hard to control, but it's good to take note down what your emotion that you're feeling just now. This is the only way you learn as an investor, as a retail investor. You have to accept that this growth sprout has to slow down. Me investing for the last 10 years, seeing a stock going 40-50% is really uncommon. It's only things I've seen in 2020, 2021. Look at your portfolio and see what high risk stock, what high growth multiple. I'm not saying don't buy high risk stock, you have to own some, but you have to own the amount that you can afford to lose. And finally, rotation stocks. Yes, we have to go to rotation stock eventually, but go to rotation stock that's not disrupted by technology. You need to rotate into a stock where it's still got technological prowess. For example, it's no harm going to McDonald's because McDonald's got technology. It's no harm going to Domino's. Domino's got technology. No harm going to Costco. Costco has got this great inventory to sell for online business. So think about a business that you want to rotate into. Rotate into an oil stock that's got great green resource and cost control, like the likes of Chevron and Total. So it's for you to sit and assess the situation, what type of rotation stock you can go into. So for me, what would I do? What's my personal point of view? For me is business is still a business. And as an investor in equity stocks, I invest in the business. Because regardless of inflation, deflation, Apple will still be selling their phones. Tesla will still be selling cars and trying to change the world to a more EV electrical, reducing carbon emission. And companies like Lemonade will still be selling insurance at a faster rate than all the other companies. So you should be investing in companies which are good value, not overgrowth by hundreds and hundreds of multiples. It's all affected by companies, how they can perform through this difficult time with their technology change. So thank you very much. I hope you find it useful. Please click like and subscribe. Hopefully I can share information like you do. Take care. Thank you. Bye.
I hope you enjoyed that video. Please like this video. and subscribe to the channel.
Please press the bell button. Ding dong.
Finally, watch the recent video up here.